for the hardware computer space with one of the biggest blowouts I can ever recall. On a day where the Dow jumped 363 points, S&P advanced 0.22%, the Nasdaq gained 0.21%, Dell with a 102-point gain, or 32% one session, defined today, creating still one more day of tech strength, even if we did see some recent winners get hit with a bizarre round of profit-taking at the end of the day. Sell. Dell's quarter was a true surprise, and Michael Dell should be very proud. But there's one great tech quarter after another in May that we saw, great results, and nearly all of them were connected to the same thing, the data center in some way, shape, or form. Today, away from Dell, we actually saw some stunning strength in a host of software companies that have underperformed of late. I'm talking about stocks like ServiceNow, Atlassian, Salesforce, Microsoft, all of which were simply, they gave you some magnificent performances as if nothing were ever wrong with them, and they'd been punished almost the whole month. Their gains were in some ways as shocking as the declines of some of the great hardware leaders in the last few minutes of today's session. At Dell, they saw incredible strength across all their businesses, but the fastest growing segment came from Dell's partnership with Nvidia, the AI pioneer with a stock that's been a bizarre underperformer of late, including today, where the company stock fell 4 points in the last few minutes of the trading session and finished down an ugly $3. It was a wild and inexplicable fall for the largest stock in the world. I didn't think it collapsed so fast on no news. No news at all. Maybe that's a good place to start our game plan then, because the week begins on Sunday night when Jensen Huang, the CEO, gives his annual Computex talk in Taiwan. Maybe something he says could reverse today's inexplicable decline. This year, Jensen plays host with some of his favorite partners, including Rene Haas at ARM Holdings. That stock held up. Matt Murphy from Marvell. Intel's Lip Bhutan. That stock did not hold up. And Qualcomm's Cristiano Amon. Computex has been a stake in the ground for many years now for Jensen Huang. And I think he may unveil something special here. Now, why do I feel that way? We got a potential hint when Nvidia's official X account posted a cryptic tweet teasing, quote, a new era of PC. The account from Microsoft Windows posted the same message, grasping at straws, doing everything I can for you. Maybe what we saw in late day trading was some sort of end of the month rebalancing out of some semis and into depleted.
The S&P 500?
Yeah, there's not much sort of interest rate sensitivity specifically for where the trajectory of earnings has been concentrated in that broader AI space. Arguably, you do potentially run into problems as you go down into the smaller companies that have less earnings or maybe don't have earnings at all and struggle to pay interest payments. So I think we'll see some differentiating at the cap level to some degree, depending on what rates do. But the most important thing for the equity market is not simply just a move by the Fed toward tighter policy. It's the speed that they have to tighten policy that matters. If the Fed, once they move to a tighter stance, can take a slow escalator up and move slowly with rate hikes, versus if they have to take a fast elevator up, the former is a much better backdrop for equities. What has happened in the past, though, in the lead-in to the first rate hike, cyclicals tend to do well. We're seeing that now. But once the Fed does start hiking, you tend to see a little bit more of a focus on defensive. So that's just another way to think about market dynamics as we approach the potential for a tighter Fed.
And when you mention AI, I want to have a conversation about CapEx, because obviously this is a huge driver right now. I mean, as I'm looking at Amazon, Microsoft, Alphabet, and Meta, each growing their CapEx by about 70% year over year in 2025. As you look at that, Lizanne, are we seeing the markets basically giving these management teams a blank check for AI infrastructure? Or are you starting to see now that investor patience is beginning to wear thin?
I think there are starting to be concerns that creep in, and I think that helps to explain what I've been calling the great chip dip recently. And it's around a confluence of things, some of which is shown here. You know, the amount of capital that is consumed from a capital spending standpoint is significantly higher than the profit contribution, as you see the share of net income, and this is relative to the S&P 500. So that gap is something to be mindful of. You also have increasing number of companies, just corporate enterprises, saying that they may have to start to consider paring back on some of the spend because we're not yet fully seeing the concrete nature of either productivity benefits or, in the case of capital spending giants, the return on invested capital. So I don't think we're in anything resembling look out below, but those concerns are starting to creep in, and I think there's a more discerning eye on a lot of these data points.
And what's your thoughts on that narrative that we start to see some of this CapEx spending slow down if we don't soon see monetization backing it?
I think you will start to hear maybe more than just anecdotal stories of kind of weighing the pros and cons of a continued massive AI spend. Even with the price of tokens coming down, the spend is still significant. One interesting way to think about it, though, and I've had conversations with corporate leaders, is they're starting to say, at what point do we look at the cost of human capital as now being relatively inexpensive? So if we think about the concerns about the disruption to the labor force associated with AI, there may be some benefit there.
Today, we need to talk about what's happening with the two of the most important companies in the AI trade right now, Nvidia and the Micron. Because something very interesting is happening beneath the surface of the semiconductor market. Micron recently delivered an extremely strong earning report. Demand for memory remains robust and companies continue spending billions of dollars on AI infrastructure. And managements continue to talk about the strong visibility into the future demand. Yet Micron stock has fallen more than 20% from its recent high. At the same time, Nvidia continued to trade below its previous high despite the fact that the world still appeared to be heavily constrained when it's come to AI computing capacity. So the questions investors are asking is simple. Is the AI trade is beginning to weaken? Or are we simply watching a normal correction after the one of the most strongest rallies semiconductor industry has ever experienced? Let's start with Micron because I think the situation surrounding these companies explain exactly what investors are struggling with right now. For the decades, memory business has been known as the one of the most cyclic part of the semiconductor industry. The cycle was relatively simple. Demand would increase, memory prices would rise, and companies would make enormous profit. And those profits would encourage manufacturers to build more production capacity. Eventually, that additional supply would enter the market and price would fall. Margin would collapse, and the investors who bought memories companies near the top of the cycle would suffer enormous losses. That history is exactly why Wall Street has traditionally refused to give companies like Micron high valuation multiples. The market simply didn't trust the earnings. Whenever Micron generated enormous profit, investors assumed those profits would eventually disappear. But today, the argument surrounding Micron is beginning to change, and the reason is artificial intelligence. Memory is no longer simply being used to store footage, photos, and the videos, applications, and traditional consumer data. Memory has become one of the most important components inside the modern infrastructure, AI infrastructure. An advanced GPU without enough memory cannot operate at its full potential. The more powerful AI models become, the more data they process. The larger the context window become, the more inferences workload increase. The more memory the entire ecosystem requires. That's why high bandwidth memories has become so important, and that's also why the current memory shortage could potentially last much longer than the previous cycle. The semiconductor industries cannot simply increase production over the night. Building a modern semiconductor fabrication facility requires billions of dollars. Then companies need to construct advanced clean rooms, install extremely complicated manufacturing equipments, hire engineers, being production and qualify those products with customers, and finally ramp the manufacturing. That entire process can take years, and high bandwidth memories create another problem. Producing HBM requires significantly more manufacturing capacity than producing traditional memory.